Have you ever wondered how banks can avoid the catastrophic disaster of Silicon Valley Bank? Well, in this video, we're going to dig in a little bit deep into the details to see how banks can avoid failure. Whether you're a banking professional or a beginner investor, you do not want to miss this. Hey, what's going on? This is Maui Voti with financiallypresent.com, your one-stop shop for financial and investment education. And today we're talking about how banks can avoid the failure that Silicon Valley Bank experienced. And it's quite unfortunate, but there are some key reasons. But let's talk about banking first, because banks are really, really important to the economy. They not only function as custodians of our actual cash, right? They also match the lenders and the borrowers. So if you have excess cash, you put it in the bank. The bank, when you open up a bank account, you have signed an agreement saying that the bank is allowed to lend your money out for different purposes. So what you'll find is that banks loan money out for reasons for people to buy cars, to start businesses, to buy homes, and to use credit cards. But essentially, that cash is tied to the people who have lent it to the bank. And then apart from that, banks have the ability to make income by investing that cash. And one of the safest ways for them is to invest in US Treasuries. But with any investment, especially an investment with interest, there's interest rate risk. The problem with interest rate risk is as interest rates change, anything you're holding with a specific interest rate, the value of that holding is going to change. Okay, so if interest rates continue to go higher, whatever you're holding with a fixed interest rate doesn't look as good. So Silicon Valley Bank owns about $21 billion worth of US Treasuries that were going to yield about 1.79%. And with interest rates being raised by the Federal Reserve for the last year, those interest rates have gone from nearly zero to about 4.75% and climbing technically because the Fed has been increasing rates to battle inflation. See, when that interest rate change happens, it affects what Silicon Valley Bank is holding. So now what you have is an investment of these US Treasuries that is going to be sold at a loss. And that's what they did. They had to sell it for a loss, $1.8 billion in losses. And because of that, they needed cash, okay? On top of that, you'll have to consider that Silicon Valley Bank had a customer base that's normally comprised of tech companies, tech startups specifically, and those are normally funded by venture capitals. So people who are interested in a new tech idea, they received a pitch from someone and they said, you know what, I'll invest with you. Those new tech companies take that money and they've put it in Silicon Valley Bank. But lately we've seen less of this. And in fact, tech companies have been really, really stingy with their cash. So deposits were much, much lower for Silicon Valley Bank. So here they are with a significant loss with the treasuries that they invested in. And then they have less deposits from their clients. So now they're in a cash crunch. They decided, hey, we need more money, so let's sell some equity. And of course, when they did this fundraising pitch, it sounded the alarm that they don't have much cash and that they are essentially in trouble. And once you have multiple people telling you that, hey, take your cash out of Silicon Valley Bank, it created what we call a bank run. And this is where people all go to their bank and decide they want to make withdrawals at the same time. And with the banking system, there's a fractional reserve banking is what most of these banks operate under. And there used to be a requirement that they would keep 10% of cash on hand to fulfill customer withdrawals. So that meant if you deposited $1,000, $100 would be kept, and the other $900 can be invested in different things, whether it's US Treasuries, whether it's loaned out to other people. But ultimately, that reserve requirement has been reduced down to zero as of 2020. So banks may or may not keep as much as they should on hand, and that's just due to new guidance, basically. But now you have all of this factored into Silicon Valley Bank, and you have to ask yourself, well, how could they have avoided this? And let's talk about that. One way Silicon Valley Bank could have avoided this is if they kept a more diverse customer base. So not just only focus on tech companies, but other industries, okay? Because again, when the cash flows and the deposits from tech companies were much lower, that's what really exposed them to this situation. But if they had a wider customer base, they would be a little bit more diverse and able to handle the cash crunch that tech companies are currently going through. The second way that Silicon Valley Bank could have avoided this is if they diversified their investments. Look, so when we talk about your own personal portfolio, we talk about not just buying one specific company, but diversifying, making sure you're looking at multiple competitors in the sector, looking at different sectors, and then also just understanding more and more about your time horizon, so many other things. But when we talk about diversification for interest-based investments like treasuries, there are concepts like a bond ladder, for example. And basically what we're doing is not concentrating our risk on a specific time frame, but we're spreading it out. You see, what they owned were some treasuries that were expiring in about 3.5 years. But there are other investments that are available where they have expirations that range from 4 weeks all the way to about 10 years. It really depends. But if you layer your investments so that you're not necessarily tying up all that cash for 3.5 years, the interest rate risk is a little bit lower, in fact, much lower, so that you're not so sensitive to the interest rate changes, especially when they've changed so much in the past year. So how can you use this information, you as an investor? You can lower your operation costs, so adjust your budget. You could increase revenue streams, so look for different ways to increase your income. And then number 3, you could increase or diversify your investment decisions, your investments in general. All right, if you diversify that, you can reduce the single points of failure or any chinks in the armor to make sure that you're not as exposed. If you like this video, I want you to hit that like button, subscribe if you're new to the page, and turn on notifications so that you don't miss out on future content. And until next time, stay present.